Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, you can watch this show as well as hear it. If you go to YouTube, Jeff Barton, the Mortgage Voice, you can not only see, you can hear, you can sign up, you can get alerts on YouTube. You can say you liked it, and you're going to get, told by us all the time that we have great shows. We have a whole bunch of different shows, but YouTube, Jeff Barton, the Mortgage Voice, and you can go there and see the show. I am Jeff Barton, and this is the Mortgage Voice. Thanks for tuning in. I really appreciate it. So, I have there's a lot of changes going on. Obviously, anybody who's looking around can see that, whether it's in your political sphere, your local sphere. I mean, kids going back to school, that's a change. And certainly in the real estate and in the mortgage industries, all those changes are coming to kind of a head right here. And we're trying to figure out whether we're going into a recession, whether we're not going into a recession, whether rates are going to go up or whether they're going to go down. By the way, they have gone up a bit in the last week, 10 days, not a huge amount. As gas prices have come down a little bit, a couple of cents a day, so too does the mortgage interest rate tick up a couple of bips a day. It's not going to make a big deal of difference to you when you get mortgage, but just be aware that that is what's happening. But the point I guess I'm getting at is it's very difficult to follow advice or try to tackle the big issues in your life. So this story, okay, so I watched a show, and this relates very much to what we're talking about. A show on Broadway many, many years ago called Walk in the Woods, and it was about the nuclear SALT talks held between Soviets and the United States to try to lower the number of warheads in the world, especially from those two countries. And the play was about the U.S. delegation and their lead negotiator. There's a couple of stars that were in it. But so on the brink of nuclear disaster, this diplomat decided to go outside and take a break from the negotiations, and he's walking in the park, and the actual play takes place in Switzerland. So he's walking in this beautiful country, and he pulls out a candy bar and he eats his candy bar, and he just happens to drop his paper wrapping on the ground. So he didn't think much of it, and he went back into deep thought. All of a sudden, there's this tap, tap, tap on his shoulder. And he looks around, and there is this very distinguished-looking Swiss police officer, all dressed, kind of elderly, actually, mustached out, very long and distinguished-looking eyebrows, and everything that you could say that looks classy about the Swiss was embodied in this guy, this police officer. And, of course, the American diplomat didn't speak any Swiss at all. And the Swiss police officer didn't speak any English. But through his forceful gesticulating with his arms and pointing and speaking in Swiss, the diplomat was going, is he talking about the paper that's on the ground? And sure enough, a crowd began to gather. And everybody in the crowd started to point at him and point down at the paper and start to get very loud and very emotional. Finally, after a couple of minutes, the U.S. diplomat had had enough, and he said, "Don't you people realize I'm trying to save the world from nuclear explosion, nuclear holocaust? Don't you understand?" And he went on like this, berating the crowd. Well, you can imagine, they all just looked at the American, head shaking, almost wagging fingers. They all turned heel and walked away, shaking their heads, murmuring to themselves, and you can imagine in Swiss. But the American diplomat was like, you've got to be kidding me. I'm trying to save the world from nuclear holocaust, and they're telling me that I've soiled their country. Well, a lot of that is what happens now in our particular mortgage industry. We are all looking at the big picture of mortgage rates. They're going up. Inflation. What's happening in the real estate world? Inventory going up? Prices coming down? The main thing when you're looking to buy a house is not to focus on the large, huge issues, but look at the piece of paper issue, which is, can you afford it? Can you look at the monthly, and is this something you want to do? Everybody knows making it in America depends on your real estate purchase, and your real estate purchase is all about your monthly payment. Your monthly payment is really, even at 5.5%, which is what the, no, it's not quite 5.5%. Where is it today? Yeah, 5.48, it's almost 5%, is not the main issue here. It's, can you afford the monthly? And if you can't afford the monthly and you stay there long enough, you will reap the benefits of owning real estate. And owning real estate is the fastest and really the best way. 9 out of 10 millionaires in the U.S. did it through real estate. And they did it through buying their home, paying it off. So if you're looking at the macro issue, like in that stupid story I told you, which was a real play into the woods, the thing to focus on is the monthly payment and can you afford it. 30-year fixed rate loan today, 5.48%. 4.82% is our 15-year. 4.82 is the FHA. 4.75 is the jumbo. And 5.70 is our 5/1 ARM. That 5/1 ARM is more expensive. And why is it more expensive? Because it's really based on the 2-year bond, not the 10-year bond. The 2-year bond today, in that inverted yield curve, is 3.285%. The 10 years at 2.875. That 10-year is really what's dictating the mortgage interest rates. We're looking at a number of things. I got a few minutes left here before I have to get to the next segment. Let's say rates to keep rising, and that means the Fed looks to probably raise the short-term interest rates that they charge member banks 50 to 75 basis points. This is a big push right now to continue hammering at the Fed. One of the main reasons is employment continues to be strong. We looked at unemployment today, really come down 15, 20,000 from what it was. First time unemployment benefits at 250,000. I think last week it was almost 275, 280. So it's come down. We really don't see the jobs disappearing that have been on the market. We still have about 10 million plus jobs available in the market, about 2 for 1. Everybody who's unemployed has 2 job opportunities. Quick story, my own son, who is in New York City, he works in the political sphere, and he's had a number of job opportunities. What they do is canvassing, door to door, that kind of stuff, and he manages, organizes, and directs those jobs for a lot of candidates. We've gone through an election cycle, and you could probably work 2 or 3 of those type of jobs during an election cycle. Anyway, he's gotten 2-3 job offers just recently. Now, that's a niche type of industry, but it just goes to show you that there are a lot of jobs out there. Unemployment is lower. It's at 3.6%, and the new job benefit claims are also down, so that's another thing. House sales down 5.9% from last month and 20% year over year. That's something to consider too. We need to see inventory rise, of course. One of the sad things, though, is that we're not going to see the builders be building more homes. And why is that? Because ever since '08, as I've said before many times in this show, what happened at that time is that the builders had extended and built spec. Well, they don't build spec anymore. They build on whatever the home builder sentiment is and whatever the projected sales will be based on a number of indices that they look at, both economists and the builders themselves. And they're looking out at demand for new housing, and it's not great. So they're not going to be building like they have been building. And in a lot of cities, that really hurts because mainly large corporations buying up properties and then renting them out takes housing off the market. Now, we haven't seen as much as we saw in 2008, but certainly we could see it if we see a recession right now. So we need more houses on the market. That's not happening. Home builders, construction over till rates come down. Yeah, that's what I just talked about. We got about a minute left. Time to think. HELOC. Okay, so the home equity line of credit is an interesting product. It leaves your first in place, but takes out a credit line against the equity in your home. Now, some of those credit lines that you can get will be locked in. Like if we go into a recession and the value of your house drops, your HELOC stays to where it was. Now, you have to shop around. You have to look to those particular product in order to get what you need and what you want. Let's see, one more. Mortgage apps down 2.3%, lowest since 2000. You're not kidding. We're going to have a couple of people on the show today to talk about not only their lenders or what they're doing in terms of getting more applications in the door. But aside from that, really appreciate you listening. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We come to you from a number of different places. One of the best places that we come from is our podcasting. We have about 7, 8, 9 podcasts, and my engineer Bud
I'm here.
Thank you very much. Podcasts are?
Oh wow, there's a bunch of them, Jeff.
Okay.
One less than a second here. We got Spotify, Apple Podcasts, Spreaker, Stitcher, iHeartMedia, YouTube, podclips.io, and themortgagevoice.com.
Excellent. All these places are where you can hear not only this show, but archives of the shows, as well as future shows that are going to show up each and every week. This type of information you really can't get unless you listen to a show like this. I'm not plugging anything, pushing anything on you. What we try to do is bring you information to make the best choices possible. And all those podcasts are the place that you can both sign up, say you like it, and get alerts as to us being able to tell you when we're on next. Anyway, I'm Jeff Barton. This is The Mortgage Voice. With me, a great guy, been around with us, for a number of years. Used to do our TV show out there in Vegas when we did the Las Vegas real estate show. Reed Blake joins us from Foresight Funding Advisors. Reed, how are you?
I'm fine, thank you, Jeff. How are you doing?
I'm fine, thank you, and thanks for coming on. I do appreciate it. It's been a while since I talked to you.
It's been a bit, yes. I'm really grateful for the opportunity to be on your show.
Okay, and thank you. All right, so Foresight, what are you guys doing now? I know that you merged with another group, and you're still bringing not only business bank statement loans, but some other types of business loans to consumers. How's business? What are you doing? Describe a little bit about what's going on.
Business is going very, very well, actually. We're
Great.
We're very, very pleased, even with the economic conditions and interest rate fluctuations and things like that. But we do primarily 2 categories of funding. We do unsecured cash funding, and then we have our real estate lines of credit. And so,
Okay.
our unsecured cash funding falls into 2 categories: unsecured cash business lines of credit, and the second one are unsecured cash loans. The lines of credit are exactly that. You draw down, pay back, forever money.
Right.
Loans, not forever money, have an amortization schedule, and we go anywhere from $15,000 to $500,000, $500,000 with unsecured, non-collateralized cash that the client can use for any legitimate business purpose that they choose.
Okay, lay out a little bit about this ability to be able to fund your business. I'm a new business owner. I have a great business plan. I got a little bit of seed money on my own, but in order to grow or get my business really humming, I need like $100,000, $200,000. What do you need to see from me in order to get that money?
Great. What we have is an underwriting process. It's very, very fast.
Okay.
We underwrite our clients anywhere from 90 minutes to 4 hours.
Wow.
So what we do is if someone were to call me, I would just send them from my phone app or the link, and they would fill out a generic questionnaire. It's pretty comprehensive. It's going to be name, address, phone number clearly.
Right.
It's also going to talk about their employment. It's going to talk about their financials, things like that. Your standard questions, but it's a generic, all-purpose, catch-all form. And then that once they complete that and click submit, that goes into our underwriting team. And literally, in a day, we have it out, and we send the client exactly what their options are. We go we'll show examples. We'll say, okay, 3-year, 5-year, 7-year, 10-year term. Here's the interest rates that you're qualifying for. Here are, here's your estimated payment, et cetera. And generally speaking, when we quote somebody how much they'll qualify for, we're going to be within $1 or $2 of exactly what they'll get. And so if they're, but the key things there are, obviously the strength of the credit profile, not so much the credit score, but the credit profile.
Okay.
The underlying profile, and then the wherewithal to make the payment. In other words, if you make $2,000 a year, the likelihood that you'll qualify for $200,000 in unsecured cash
Not so good.
is going to be not so great.
Right, you're looking
On
really...
the other hand...
Go ahead, I'm sorry. No, I was just going to say, you're looking for really somebody who has something that is making money and they need something to grow, but obviously the payments that they need to make has to come out of the cash that they're currently making, not on futurized cash.
Right. Especially right now.
Right, especially right now. Now, availability of funds as well as qualification for those funds. Now, and cost, of course, all these things are important, but in this market where we've seen tightening credit, not only from the Fed, but most lenders out there, certainly business lenders who are looking at, as you just said, they're looking at more than just a score. They're looking at, okay, what's your credit payment history like the last 18 months, 2 years? Is that pretty much what you're looking at too?
Yeah. Well, they'd be looking at that, but they're also going to be looking at the underlying, what's called the profile.
Okay.
So you have your FICO score, and then you have the data that makes up that score.
Right.
And so they're going to be looking at the strength of the client's profile. So you may have somebody with a 700 or 720 score. Excuse me, hold on. Pardon me. A 720 score who has a stronger profile than someone who has a 780 score. What makes up that score, if that makes sense?
Of course.
We used to tease about my daughter. My beautiful, blonde-haired, green-eyed daughter.
Uh-huh.
She has a 780 something. So again, great score. However, It's made up of a Pier 1 card, a Kohl's card.
Right.
Not Victoria's Secret. Dad's not happy about that. A couple of merchant type cards. So
Right.
again, she handles this all great. She has a real high score. However, that profile that made up the score is not a strong business lending profile. Does that make sense?
Of course it is. So you're really looking for car payments, mortgage payments, larger payments that are paid off over a number of years, something like that?
Yes. Yeah, exactly. Strength of profile. How did they handle things during the COVID shutdown?
Right.
Did they still make their payments? Did deferment, things like that.
Okay, well
And then the flip side is a real estate line of credit.
Okay.
Hang on just a second, Jeff. I'm sorry.
Yeah, go ahead. No, and I think the real estate line of credit is really important because you're drawing down on existing equity in your house, or is this more
No.
a freestanding signature loan where you're taking out to purchase real estate?
Okay, great. It's kind of it's kind of not either one of those.
Oh, okay. No,
What it
please
is,
educate me. Let me know what's going on.
Yeah, it's an actual real estate line of credit.
Okay.
The minimum amount is $500,000 that you can get. The most you can get. This is the initial limit, operative word initial. The most it will be is $10 million. Okay, and it is based upon one factor. This is going to sound crazy. Then I'll get to how it's used. And one factor only, and that is the middle score has to be 640 or higher, even right now. Now, there are other criteria that will determine what the initial limit is. But to get a yay or a nay on it, it's a 640 middle score. But it's an actual line of it's a line of credit that is used exclusively for real estate. So let's say that we qualify you for $1 million to begin with. You now have $1 million to go out and pursue real estate. You're not running around with your hat in your hand trying to find private money guys or negotiate with hard money guys, etc. You've got capital.
Right.
You can go out and disperse. You get to deploy that capital and put it to work. It can only be used for real estate. It can only be used for real estate investments. It can't be used for your personal residence or anything like that. And so
now, Reed, quickly. I have about a minute left. When you purchase that real estate, does this line of credit get attached to the property, or is it still?
Yep.
It does. Okay.
Yeah. So again, let's say that you've got you're able to acquire a property for $300,000.
Right.
$300,000 of your real estate line of credit would then be used for that, leaving your available balance $700,000, Well, that 300,000 is being deployed. When that property flips, if you're doing a fix and flip on it, then that 300,000 at closing goes back to your line of credit, and you go back up to $1 million.
Hey, Reed.
Or you can simultaneously have 3 or 4 projects going on at the same time.
We are up against it. As always, this is too short of a conversation. We'll have to do it again. Tell people how they can get a hold of you. Where do they get the application website? What's the link? All that stuff.
Yeah. Well, as always, with you, Jeff, people get access. Your audience gets access to my direct cell phone.
Excellent.
That number is 801-830-6240. Again, that number is 801-830-6240. They contact me. I'll be happy to visit with them. I can schedule a time to go through our 20-minute little PowerPoint presentation, or I can send them the link directly from my phone, and they can jump in and begin the qualification process.
Reed, thank you very much. Great information. In this market, this is like a godsend for some people, so I appreciate you coming on the show.
Thank you, Jeff. Again, I appreciate the opportunity. Your audience is always a class and sharp group of people to work with.
Thank you very much. This is Reed Blake, Foresight Funding Advisors. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, not only do we have great podcasts, but also we're on YouTube, and we're also on regular terrestrial radio. We're on 5 stations in 3 different states. We're at KCAA, KMET in Southern California, K-Tahoe up in the Tahoe area of California, and we're at K-Mine Country down in Albuquerque, New Mexico, as well as, where else are we? We're in Vegas, right?
We are in Las Vegas at K-Ship or
K-Ship, right. AM 1400. Most of these shows can be seen on the weekends, Saturday or Sunday, or both. And we bring information about mortgages, information about real estate. Listen, it's a changing market, and you need the best and most qualified information out there. We try not to pitch anything. We just try to provide you with best case scenarios, worst case scenarios, and what's happening right now. And in order to help me do that, I think, Martin, you've been on the show maybe one other time. I'm not sure.
I have. Yes, I have.
Okay, excellent.
One other time, so thanks for inviting me back.
No problem. He's a partner over at Nations Direct Mortgage since 2007. Really got his ear and to the ground, knowing what's happening. How are you?
I'm doing great. I'm doing okay. We're hanging in there. We're providing financing. We're a wholesale lender, servicer here in Southern California. We lend, all over the country, but
right.
We're hanging in there. We're doing the best we can.
Excellent. That you say that, I wanted to ask you, a lot of the competition in the space has been laying people off and changing the way they're doing business, whether it's Lone Stream or whether it's Wells Fargo. We just seem to see a major contraction as, obviously refinances are really down. How is Nations handling that particular aspect of it? And maybe look towards what's going to be happening in the next 3 to 4 months towards the end of the year with rates.
Yeah, great question. So, we are a wholesale lender and servicer. So
right.
We're fortunate that we do have our servicing of the loans that we've closed over the past 10 years, noted that are serviced by our Nations Direct. So it's a nice revenue model when we don't necessarily have the origination that we do when the rates are lower.
Right.
So that's been nice. Unfortunately, we had to lay off employees, which really stinks.
Yep.
But hopefully one day we'll be able to bring those folks back. Now what I'm seeing a lot of purchases, which is great all over the country. And what we're seeing is government loans, FHA loans that we didn't see before because those borrowers were maybe set aside. Maybe they weren't able to get some of the properties that were in so much competition.
Right.
So they're able to buy some homes now, which is that's been we've always been a purchase lender, so we've been pretty fortunate, especially to be in that government space.
Excellent. Figuring on purchases, because everybody's competing for purchases, the niches that some of the non-QM type lenders come out with are a lot. Bank statement loans, TIN numbers. There's just a number of different products that have come out in the last, I don't know, I guess they continue to come out in the last 3 or 4 months, anticipating, I think, this kind of, I don't know, fallback in the refinance market. What are some of the products that you may be able to talk about over at Nations that might be attractive in this type of market?
Sure. Obviously, number one is our government offerings, because we do lend on both veterans and FHA first-time home buyers with maybe a little bit more challenged credit down to a 550 FICO score, which a lot of lenders don't do that.
Right.
So we're able to get some credit availability to those folks. And then to your point, I think our last call was about the non-QM alt-prime market for those borrowers that were self-employed or are self-employed that came out of the pandemic. I mean, unfortunately, borrowers lost their jobs, so they went and started their own side hustle. That side hustle became a business. That business became a viable operation and cash flow, and now they can purchase homes. And so that's been a viable part of our business, as well as the investor loans, investors purchasing properties throughout the United States, certain segments where they're able to get some revenue from renters.
Are you worried about the quality of the loans now? I mean, for the last 2 or 3 years during the pandemic, obviously we've seen such a flood of new loans, but it's really been based on the lower interest rates, and anybody taking advantage of it that had been paying a higher rate mortgage is obviously qualified to pay the lower rate mortgage. Are you worried now that since we're in this kind of transition period, not really sure where the rates are going to end up, that the quality of loans that we're seeing, well, let me just ask you, what are the quality of the loans that you see? FICO score, the type of income that they're making. Are you seeing any drop off in the type of borrowers that are coming to your Nations?
Not necessarily.
Okay.
I'll tell you, in the non-QM space, your average FICO scores in the mid 700s. LTV is 70%. Reserves.
Wow.
I mean, these are top quality. These are great loans.
Yes, they are.
On the government side, you're all spectrums from perhaps a lower FICO score, but then they have to, they may have to put a down payment in to those borrowers that maybe do have the gift funds. But Jeff, with the number of with rents going up as high as they are,
ridiculous.
It's in just trying to find a property. I mean, the stories that I see or I review when we're looking at these applications, purchasing a property, even if it's at a higher rate, perhaps in the 5s. I mean, you can get an FHA loan today if you have strong credit. You're still in the mid 4s, low 4s.
Yep.
Working with a mortgage broker or VA, in the low 4s. Working with a mortgage broker. So, and it's still cheaper than renting. And obviously, and I know that you get the tax reduction, up to $10,000 on property taxes in your interest. So, it's and especially if its values stay the same, or even if they go up a little bit, you're still better off.
In your estimation, where do you see the interest rates, the actual mortgage rates going? Are you closely following, or do you have a committee that follows that, or is it just...
I watch a number of different barometers.
Yep.
When the economy is doing well, rates are going to go up.
Yep.
Is the economy doing well? Maybe not as well as as we think. You and I have seen our rates, even last week, jump up a half, go down a half.
Yeah. Very volatile.
Extremely. I don't see them going higher. I don't see them going at 70% that, my neighbors think it's going to happen. I feel that they're going to be stable. Let's see what happens. Fourth quarter. If we do have some sort of slowdown in the economy, we'll see rates, perhaps come down.
Yep.
That will be a positive for the home buyers. My concern is if I would look at from 30,000 feet up there, inventory.
Yep.
We're still, depending on certain geographical areas, there might be some more inventory, whether it be Boise, Idaho, Arizona, Texas, maybe perhaps some parts in Florida, that they may have some more inventory than other states, but inventory is still a challenge.
Yes, it
because
is.
people have low rates right now, and they may not want to put those homes in the market.
Yeah, I think the rates really, obviously the bad market, we're going to see rates go down because they want to stimulate the economy. I mean, that's just, basically what's happened in the last 20
Right.
years. Since the dot-com bubble, we've just seen those cycles go through 2 or 3 times. I think with everything else going on in the economy, it's a wait and see, but at the same time, rates are still pretty good. And I keep telling people, stop focusing on the world or the politics and just look, is this a monthly payment that looks good to you? Can you afford this monthly
Listen.
payment? Then get into the real estate market.
Yeah, in the borrowers that I see now, they're almost, they're almost happier that they don't have to shop,
Right.
in deep stressed out or distracted, and looking at dozens of homes, and maybe finding and getting a better deal, or I'm seeing more concessions than you and I have seen in years.
Yep, yeah, I agree.
Where the seller is part of paying for the borrower's closing costs. That's been very helpful, and we're seeing more of that in the last few months than we've seen.
Yeah, in the last 2 years. I agree. Martin, we're up against it. Unfortunately, I got to jump to another call, but I really appreciate you once again coming on. I always enjoy the talk, and obviously coming from you, it means a lot, and I appreciate it.
You're welcome. Nice talking to you, Jeff. I'll talk to you soon.
Okay, very good. That's Martin Wern. He is the partner since 2007 over at Nations Direct Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. We bring to you unbelievable information, great guests, and certainly commentary from me about what's happening both in the economy as a macro sense, and then we dig down into the weeds with the people we bring on the show to really figure out what's happening in a micro level to you. We have a website. I don't know if anybody's seen it. It's been out there for a bunch of years, and it's called themortgagevoice.com. If you go there, you can not only hear this show, but you can see the guests that come on the show. If you want to contact them, you can go through the website. You can hook up with them, find out information that you couldn't get on the show that you wanted to hear but just didn't have time to either listen to the whole show or you wanted to be able to contact them directly. Anyway, Jeff, go to themortgagevoice.com. It's a great place that you can visit us on a daily basis. I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, so we come to the show. As I said, we bring guests. We bring guests from lenders from all walks of the real estate and mortgage industry. And our next guest is Ryan Bagan, who's at 11 Mortgage. Been on the show before. You guys going to talk us to a little bit about what's happening in their world, the world of mortgages, and of course products they have. Ryan, how are you?
I'm doing fantastic, Jeff. Thanks so much for having me on the show.
Thank you. All right, ready, go. No, so, tell me a little bit about some of the programs that you have over at 11 Mortgage that might help out people in these times right now.
Well, actually, I'm super excited. We just re-released the CalHAPA program, which is our first-time home buyer product.
Yep.
Which offers a down payment assistance and even it helps pay for closing costs. So if your borrower doesn't have one of the three C's being credit, career, and cash, so if they don't have the cash but they have the credit and career, we can offer them very little money out of pocket. I'm not going to say zero. If it's a perfect scenario, we can get a seller to give us 2% for closing costs, which I think the market is going to start to move into here. Then it could be 0% out of pocket. But I would like to say little to no money out of pocket. Okay.
And what type of loan
know,
is that? Is that like an FHA loan?
It's offered under VA, USDA, FHA, and
Okay.
conventional.
Great.
But what we're selling is FHA and conventional.
Okay, excellent.
And it's FHA is a standard 96.5%, 3.5% second, and then conventional is 97% with the 3% down, or the 3% second.
Excellent. Okay, so these programs, they're fairly new, and they used to be around a lot more several years ago. That's before we had the COVID and before we had a few other great years in the real estate and the mortgage business. How's the response been?
It's been fantastic because you know what? A lot of people, unfortunately, are worried about getting rid of all their cash, right? Because what's going on, how the market's reacting, the inflation on certain household goods, the inflation in gas, the inflation in daily expenses, okay?
Right.
But this product allows you to enter into a house if you're renting, okay? You're paying your landlord's mortgage,
Yep.
okay? This product allows you to enter into the market with little to no money out of pocket, and you can get into a home which you start to build equity in, okay? So it's been blowing up. We're doing a lot of first-time, my partners, Malibu Funding is doing a lot of first-time home buyer seminars to give them exposure to the product that we're offering, and to show them the benefits of it.
Now,
So it's been really growing. We're getting a lot of positive response for it, and we're helping a lot of first-time home buyers move into accomplishing a dream of owning their own home. You know what I mean?
I
Helping
do.
a lot of families that would not otherwise have the ability to do so move into their first home, and we're getting a lot of positive response from it, and we're helping a lot of people, and that's what's really exciting for me.
Let me ask you a question about the FICO scores and some of the other things that you had mentioned, the 3 Cs. Obviously, we have been seeing, because of the down payment and also because of the credit scores, over the last couple of years during when rates are really low, most of those loans are pretty solid. And the portfolios that are still around, basically the mortgage-backed securities that have been sold as a result of these terrific loans are solid. Do you have any fear that some of these newer products, not yours per se or not the customers you're currently dealing with, but is it a consideration over at Mortgage 11 that the loans that you're going to be giving out through this Cal Halfa program may be a little bit more risky than some other loans? I know that that's been a big topic ever since '08, of course, but what's your thought on that?
Well, there's a lot of speculation when it comes to that kind of stuff, Jeff. Actually, so let me give you an example. The FHA has a 640 FICO requirement on Cal Halfa.
Okay.
You can do FHA loans down to 500 with other investors. Okay?
Yes, you
Some
can.
investors go down to 500. Our requirement for a FICO score on a conventional is 680 for Cal Halfa. Actually, not our requirement, Cal Halfa. You can go down to 620 on a standard conventional loan. So this is not, for lack of a better term, this is not a product where you push your underqualified borrowers.
Right.
This product was designed, I believe it rolled out in 1976 to help the Californians obtain home ownership, which they couldn't normally do. Okay, this is not for everybody. This is a specific program in California to help California build home ownership. And now there's a lot of other products, and based on the market right now, we're moving sideways. The prices are kind of stagnant in certain areas. They're going down.
Yep.
You're starting to see closing costs given by the seller when
Yep.
offers were $100,000 over the list price. Okay, so the market's moving sideways. There's a lot of other. This is more of a conservative bet. Okay, there's a lot of other products in the market, in my opinion, like the non-QM loans that go to 90%, the BOE only loans that you're starting to see come around, which I think those are much more predatory. Not to mention the non-QM side, they have all these prepayment penalties.
Yep.
You have a 6.375 rate with a 3-year prepay. You can't even get out of that loan if you wanted to. So I think that's a much bigger ticking time bomb than the loans that we're talking about at Cal Halfa. This is for the first-time home buyer that is starting the family, that doesn't have the money, that wants to obtain home ownership, and that's what this program is for. That's specifically what Cal Halfa was designed to do, and that's what they're doing to this day.
Excellent
quite
explanation.
exciting.
Yeah, no, that's exactly right. I mean, the fact is that you're showing the difference between an FHA loan at a 500, 550 FICO score versus this is at 680 FICO score, which is a pretty darn good FICO score for a first-time home buyer and somebody who's trying to get into a home. It's not easy. Rents are really high, and really moving into something that you can afford the mortgage on, that's a good thing. What are the rates on these kind of loans?
It's actually, Jeff, it's kind of tough because it moves every day. So
Yep.
your prevailing rate, maybe your lowest rate's like a 4.875.
Right.
And then your highest rate's going to be like 6.125 rate.
Okay.
So it's not, you might be able to get a better rate, but you're not going to be able to get the benefits of this.
Right. No, the CalHFA program is specific to certain lenders that do it, right? Not everybody offers it.
No, we're one of the, it's kind of funny, we're 11 Mortgage, but we're one of the 11 wholesale companies offering this product.
No, that I agree. I think the exclusivity of it means that it's obviously something that is wanted, and people who need that kind of down payment. Could you just let people know how they can get in touch with you to talk a little bit about it, or where do they go to find out more about CalHFA?
Well, you can go to CalHFA's website, which is a great resource when it comes to things like that, or
Great.
they can always give me a call, and we can go over it whenever they would like at area code 661-414-4730. I'd love to be able to, a resource to anybody looking to become a first-time home buyer. We can definitely refer them over to our great partner, Malibu Funding, which is, fully approved with us, does a lot of business with us, and they have very low compensation, so they always offer the best product and, the most affordable option for our borrowers. So, other than that,
I appreciate that, and Malibu Funding is the sponsor of the show. Their NMLS number is 79620. I work for Malibu Funding, so I do appreciate the plug. I have just one more question for you. In terms of where the market is headed, next 2, 3, 4 months, where do you think we are in terms of rate? Where do you think we are in terms of the economy?
Okay, so let me go back to something, okay? There's a book called Who Moved My Cheese, okay?
Right.
So right now the cheese was moved. So the market's moving sideways. We have to work harder. We have to be more diligent. We have to lock in our loans when we get them because we don't know. Before the market was moving sideways, so you really got complacent, okay? All the LOs got complacent. There's so much, the rates were so low that you could sell everybody. Now the market's moving sideways. I don't know. I think they're going to come back down, but I don't have I'm not a genius.
Right.
I don't have a crystal ball. I personally think they're going to come back down because of what I'm seeing. We're kind of hovering between 2.7 to 2.8 on the 10-year.
Right.
So I think if we can stay below the 2.8, I think we'll be good to go, and it'll move sideways rather than up. But there's a lot of speculation when it comes to it. The economy I don't think is doing that good. I think the inflation is hitting the everyday individual, the family member. You know what I mean? Gasoline has come back down a little bit here, but I think people are not going to be spending as much. I think, there's a lot of variables. It's really
Yes,
tough
there
to really,
is.
you know what I mean?
Yes,
I
I
could go on
do.
for hours, all the angles that we have to really think about. So that in itself that's a predicament. But right now, what I think is going to happen, the market's going to move sideways. If the rates, if the 10-year stays between 2.8, 2.7, the market's going to move sideways. But I think there's going to be a lot of sellers that are going to want to move out. And they're going to want to sell, and they're going to start giving up closing costs and things like that because
I
there's
agree.
a lot more inventory. Because houses are sitting on the market longer. If you're going to sell, do it now. Because the houses, I'm seeing price reductions on houses that used to sell for $50,000 over. I'm seeing sellers give 3% closing cost credit when they used to say, go, get out of here. So the market is shifting. So if the market shifts that way, it's going to become a buyer-friendly market, which we're going to be able to help all these people that want to get a CalHFA loan, down payment assistance, because we're going to go to the seller and say, listen, we want 2 to 3% closing costs. Then you literally go into the house with zero money out of pocket, and then you
Right.
build up your FICO score, you start building equity, and then we can refinance that loan later down the line. So I think it's going to be a buyer's market in the near future, but I think the prices will stay kind of flat because there's so much demand. The demand is still
Hey.
there, and a lot of people are
Ryan?
moving here, a lot of people are moving out.
I got to run to the next guy in line, and I appreciate your coming on the air once again. I want to have you back to give us an update on what's going on with these programs and the success you're having over at 11 Mortgage. Thanks for coming on.
My pleasure, Jeff. Take it easy. Let me know if you need anything, okay?
I sure
Talk to you
will.
soon.
That's Ryan Bagan from 11 Mortgage. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We can be seen, we can be heard. You can go find us on podcasts. You can look at our website, Jeff Barton, The Mortgage Voice on YouTube. We have so many ways by which you can participate. Now, we do a minute show about 2-3 times a week. It's really 5 minutes, but we call it the Mortgage Minute. We do it on LinkedIn, we do it on Instagram, we do it on Facebook. Now, I had a camera that broke on my computer, so I used my phone the other day, and I'm getting some pretty good feedback on the phone, even though not only did I look terrible, but I can't hold the phone steady to save my life. But anyway, if you are in any of these areas, Jeff Barton, look me up. I'm everywhere: LinkedIn, Instagram, Facebook, and just request. We'll hook up and make sure that you get the information that we're providing. This particular show is on YouTube, and it's on many radio stations. So, given that what it is, I am Jeff Barton. This is The Mortgage Voice. And with us right now is a friend of the show, been around with us doing this particular type of show, providing information to you, is Wendy Van Wessel. And she's from Kind Lending, a nice lender run by Glenn Stearns, I believe. Is that correct?
That is correct. Glenn Stearns, also Underdog Millionaire, and I think now Grit, I think he has out there too.
What's it called?
It's called Grit. He and I think Branson are doing Grit together, and he also was the Undercover Millionaire, where he did the barbecue restaurant. He had like about $100 in his pocket, and he had to start a business.
Oh, very,
out there. Yeah.
very interesting. No, good for him. I always appreciate it. And in thinking today about the name of the company, and people in the audience may or may not know that he used to own Stearns Lending, and then they sold that for a number of months ago, maybe a year ago. How long ago? About a year ago, year and a half?
A couple years ago to Blackstone, and he got a pretty penny for it.
Oh, I'm sure he did. But I guess what I was saying is that he very well versed in not only the mortgage business, but obviously in other entrepreneurial skills. But the name Kind Lending really goes to who you are as an account executive, and I assume a lot of people within the company understanding borrowers more than just numbers. And I think that's an important thing to consider when you're looking for a lender to use, especially in a market like today's.
100%. Glenn wanted to start this company. He's been in the business for over 30 years, and he wanted to bring over the people that he knew worked well and put the brokers and the borrowers' needs and just jumped to try and make things work. And that's exactly what we have. We have a very strong team. We've all worked together for a long, long time.
Right.
Ops and on the outside AE team. So it's growing. We're growing when others are shrinking, and we also are growing our products as well.
That's interesting. Okay, a couple things, right? We see from Wells Fargo to Lone Stream to, I don't know, any number of other lenders, as well as Compass and a couple of other real estate firms, all laying people off, all looking to, better days in the future while they're trying to circle the wagons on their business models today. Tell us a little bit about, as you said, the company Kind is growing, but what are some of the products that you're using to grow that company?
Well, what's back is a 2-1 buy down. It's a seller 2-to-1 buy down. You qualify them off the normal rate, but if the seller and or builder, because we have 120-day locks, are willing to buy down the rate that they have to pay in the first year is 2% lower than their rate. And then the second year is 1% lower than their rate. I priced out a conventional loan last week at I think it was 4.99, and so the start rate would have been 2.99 and then 3.99 and then going to 4.99, which is wonderful when you're moving into a home, when you know that you're going to get promoted, when you are an intern and you know that the internship is going to be over in a year or two. Those are beautiful loans, and if the seller and or builder are willing to pay them, it's a great way to get a foot in the door. How's that?
No, that's a great idea. It's a product I'm very unfamiliar with. Tell me a little bit more about it in terms of, so you have an introductory rate, really, is what this is, that the difference is being made up by either kind lending and the builder together pay the difference, or they just...
It's this particular one is for conventional loans and FHA loans.
Okay.
And it is only, it's not paid for by a higher rate with the yield spread premium. It is paid for by either the seller of the property or the builder. It can't be paid for by the rate or by the lender or by anybody else. The borrower needs to be paid for by the seller and or builder.
Now,
and I think that they're trying to make it more attractive. I mean, sometimes they would go back to the seller and they make the purchase price higher, and then they give them $10,000 towards closing costs. Well, this is just getting their rate a lot lower for the first 2 years of the loan. So it's a 2-1 buy down.
So they have to pay for it. Do they come out of pocket on a monthly, or is it like you say, they just write a check at the end, or how does that work?
In the beginning, the seller and or the builder. So we have a really simple calculator. I think I did one the other day. It was a $600,000 loan. And in order for it to get to the 2.99%, the seller was willing to put in $13,000.
Oh.
Or the builder. And they do that up front in the loan, and so that way they are buying that rate for the first year down to 2.99, and for the second year down to 3.99 when the loan closes.
Yeah,
so those
right.
rates are going to be there.
That's very interesting. You know, in terms of the market and how quickly it turns, I mean, it wasn't like 2 or 3 months ago when you'd have multiple offers, everything going way above asking. Now you're looking at trying to help out the buyer by getting the builder or the seller or both to chip in, you know?
You know, there was an article that I read, I think that Brian Hale shared it on LinkedIn, and it was talking about how a lot of buyers are backing out because of the affordability, because the rates are going higher. Well, this allows them to be able to afford to live in the house. I mean, they have enough money, but they don't want to put it all into their mortgage, so they have a 2-year reprieve, and hopefully we'll be on the other side in a couple of years, and maybe, like I said before, they know that they're going to get promotions or they're in an internship, and those things will change for them as well. So it allows more people to qualify. We already go down to a 580 FICO score for an FHA VA loan, and we also do manual underwrites, meaning that if they don't have a FICO score, they can do non-traditional credit. So don't think if you don't have a FICO score, you can't get a loan. If you have proof that you've made your payments on cars, on cell phones, on gas, electricity, non-traditional credit, you can still get a loan.
Now, are you also taking rent payments as part of the credit profile?
Yes. Oh, yes.
Okay.
Oh, yes. That's non-traditional credit.
Right.
So, yes. And also, if you guys are out not in the middle of the city, look into USDA rural loans, because those go to 101%.
Well, the trouble with those USDA loans, and I like the product, but try to get an appraiser out there to appraise what the purchase price is going to be is kind of difficult, especially in areas that you just don't have comparable sales.
That is the onus of the appraiser. That is correct. Right. I have one that's in Calaveras County, the Jumping Frog County up there in Northern California. It's on 120 acres, and we have panel appraisers, and we have a big array of AMC companies that we can go through too, and we take transferred appraisals too. So if they're somewhere else and they don't want to have another appraisal, we could take a transferred appraisal too, as long as it was ordered through an appraisal management company. That way there's not undue pressure for the value put on. That's why they were created by the Frank-Dodd Act, although that's expired now, but I don't think the AMCs are going to go anywhere.
Oh, that's interesting. So in Dodd-Frank, they had a sunset on that appraisal management company requirement?
Correct. It was almost a couple of years ago now.
Oh, boy.
Well, they're going anywhere?
No, you're the first person that's told me about it, but then again, you have some inside sources that I don't particularly have when it comes to appraisals and knowing that kind of stuff.
Yeah, and my significant other is an expert appraiser, and
yes, I knew that.
35 years. Yeah,
that's what I was referring to.
Yes.
You know this stuff way better than I do. That's for sure.
Well, no, not necessarily true. You know the values of properties out there too.
It's funny.
And they are kind of plateauing, aren't they?
Hey, plateauing, I can see in a lot of areas. We just had a couple of guests on that were talking about, that negotiating has become now much more of an art than just slam dunk, highest price, no contingencies. No, you actually are getting sellers that have to provide some negotiation, i.e., maybe some give on the inspections, maybe some give on the amount of money that they can give in a concession when an FHA loan, all that kind of stuff.
Yep. And I think that FHA and VA are being looked at again because the all-cash offers and the highest bid going, $80,000-$100,000 over asking price or more,
Right.
depending on the value of the property, is not as prevalent as it was before.
No, and I totally agree. Wendy, we're up against it. Shout out a phone number. Let people know how they can get in touch with someone, especially asking questions about these great products.
Anytime. 818-292-2572. That's 818-292-2572.
Excellent. Wendy, thanks very much. Thanks for coming on again. You're always the best guest I have. Thank you.
Thanks, Jeff. Have a great day, everybody.
And you too. That's Wendy Van Wessel from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.